typical analysis that's retail, but what makes it different here? Like, what is it that you should be trying to aspire to understand? Now, obviously, a lecture like this isn't intended to obviously do a compendium. Like, it's not going to be a be all end all panacea. But if it's a conversation that you would have with me if we just met somewhere, perhaps in a cafe, we introduced ourselves, and through casual conversation, the idea of, what do you do for a living? And obviously, I've had that happen over the course of my life many times. You'd be surprised how many people really don't understand what it is that we do. And this is kind of like a discussion for the very brand new students that come to this channel. Now, some of you aren't going to learn a whole lot from this, the ones that have been here for a long time. This is going to be kind of like what you already know. Now, don't let that discourage you, because you might catch something in this teaching that you weren't expecting. I was going to do this in 3 sessions or 3 volumes, but after doing some outlining and such, I kind of streamlined it into this presentation here. So, bridge builders is kind of like the topic of what is it that you're going to be trying to do as a trader, as a student, as a technician. What is it that you're aiming to do in the marketplace? Now, the overview of this presentation is the theme of a bridge and the building of that bridge. Now, that's an analogy, obviously, but applying it to this presentation, in the first stage would be design, where you envision trade setups. Like, what does it look like? Because there's a lot of people coming to the channel all the time, over 350,000 followers on the channel now, which I'm absolutely humbled by. Thank you very much. What do these setups look like? And what's the inception and what's the terminus? Where does it begin? Where does it end? And loosely, that is the trade idea. So what is it you go into the charts looking for and hunting? That idea of a bridge will make more sense as we get further along in the discussion here, but the second stage of this presentation is framework. How do we frame trade setups? How can you frame a trade setup? And the understanding of redelivery and rebalance the price. So how do trades unfold? We'll talk a little bit about that as well. And the final phase of this presentation will be building. So the trade setups themselves, timeframes and sessions, and where trades form. So the trade setups themselves, timeframes and sessions, and where trades form. All right, so I want you to take a look at this depiction of a bridge and where trades form. All right, so I want you to take a look at this depiction of a bridge. It's just simply a profile picture of a bridge. To be quite honest with you, I don't know what bridge this would be representing. It may not be a real bridge. It may very well be a bridge. I don't know. I just grabbed one off the internet to illustrate this analogy. So if we were to assume that you and I had just met, and I'm trying to convey the idea that what we're looking for as a technician, as a trader, a price action trader, we're looking for an opportunity where price is right now at the market and where it will likely be at a later time. Now, that later time is not imperative to know at the moment right now because this is a casual conversation. But the idea is that we think that price is going to be from where it is right now to another price, higher or lower. Now, in terms of discussing this with the analogy of a bridge, obviously you would come to the conclusion that if you were on the left-hand side of the bridge and you were wanting to go to the right-hand side of the bridge from this perspective, the beginning of the move, the origin, or wherever the market price is right now, that is the inception of the move. And where you're trying to get to the other side of that bridge, or where price is likely to go to in the future based on your assumptions and your analysis, bias, that's terminus, where that ends. Now, in between both sides of this bridge, moving left to right, there's a lot of things that take place on that bridge. Vice versa, if you're on the right-hand side of the bridge and you're trying to go to the left-hand side, the right-hand side would be the origin of where the market is right now, or the inception of the price move that you're trying to capitalize on, and moving to the left side of the bridge. That would be where terminus resides, or the end of the move. Now, obviously, much like this bridge would represent here, if you were on either side and got to the other side of the bridge, it doesn't mean it's the end. Obviously, the road would continue into another direction and maybe branch off in other directions, much like the market would as well. But we're only looking for a snapshot in price action, a right now moment, something to capitalize on where we can frame it with this logic in mind. Now, perhaps you've had the pleasure of sitting in traffic on a bridge. I have had the unfortunate experience of sitting in New York traffic on the George Washington Bridge, on the Verrazano Bridge, and it's a little unnerving, and it was usually when they were doing construction. When you're on these bridges, and I know some of you are like, get to the point. If you're that type of student or that kind of viewer, I suggest you don't even follow this channel because I like to go into detail, and they are needed details because the world today is thinking that everything should be done in 144 characters, okay, or in 20 seconds, and you can't learn this in that little bit of time. So do yourself a favor, go watch somebody else that thinks they can condense all this stuff in 5 minutes. You're not going to learn it all there. You'll be back here, but just know that you can't learn it quickly. But if you're on a bridge like this and you're going through a construction zone, there's a lot of activity going on. And you may have to change lanes. You may have to move into one single lane where it would usually be 2 lanes. Those detours, those deviations from what you would expect or what would otherwise be a very smooth transition from one side of the bridge to the next, that's what a reasonable assumption would be. But traffic, much like market volatility, presents its own deviations, detours, and delays. So it's a matter of understanding that where we are on the marketplace relative to the time frame you're looking at, that might be a daily chart, it might be an hourly chart, it might be a 15-minute time frame, it could be a second chart, 15-second, 30-second chart, 1-minute chart. Whatever that time frame is, you're looking for that bridge from where price is right now and where it's likely to go to next. You're not trying to hold on to a 10-year move. You're not investing, okay? I don't teach investing. I think that velocity is the answer, and you can take a small amount of equity and parlay that up with velocity. That means getting in, getting out, getting in, getting out. Now, you have higher transaction costs with that, admittedly. I wouldn't argue that. But in the hands of someone that is versed with sound logic and price action concepts that I'm sharing, the potential is there for you to outpace the costs of commissions and fees that would be associated with your trading. Not everyone is going to have that result. There's a lot of growing that has to take place, and I am always doing my utmost to prevent myself from presenting it as a sugar-coated approach to going out and making quote unquote money. But the skill set of understanding where the price is right now and where it's likely to go to, that framework is how you're designing your understanding that repeats over and over in price charts and studying price. These phenomenon repeat. How many times have you seen a bridge that looks exactly like the last few that you've seen if you were on a road trip? They don't really look alike, but they do the same thing. They bridge one point to the other. They look similar in some ways, but they're not identical. Just like every time you get into a trade, it's going to look familiar. This is where price is. It's probably going to reach to that pool of liquidity above an old high or below an old low. So you can envision that idea. That trade idea, you can visualize it by looking at price. You only understand that by going through old price data. So we study price data, we look at charts, and because of history repeating itself and the fractal nature of price action creating these similar patterns that repeat on all time frames, that's the premise that we go into. Old chart data, hindsight moves. So it teaches us what the framework is likely to be after we understand how the trade itself is envisioned. So if we're looking for something that's bullish, we're naturally going to be assuming that the market's going to be moving from where the market is right now at market price to a higher level or a higher price. The idea of being able to see or envision the trade setup is going to be hinging directly on how much time you go into old price moves and study them in detail, not just casually looking, oh, it moved this much money or this many pips or this many points or handles in the index futures market. You want to know all the details. What day it took place, what time of day, what month, how many points did it move, how much drawdown did it have, and what's the characteristics of that type of move, and was there a high impact or medium impact news driver that come out around or just after or before that move began and where it ended. So that data that you're collecting that provides you a foundation, a pseudo experience. You didn't take those trades, you can't go back in time, but it allows us to digest that material and place it in our understanding so that way we can start watching price right now going forward with a forward testing. Now, when we're looking at price data, there are things in price that you've learned from me here that are inefficient. Now, inefficiencies, if we're going to be using the analogy with the bridge, a bridge is not built from both sides at the same time without the same plan. Otherwise, you'll get results like this, where they won't meet in the middle. But the market many times creates this very situation just like this. This, to me, very closely represents a gap, a volume imbalance, or a fair value gap. Those three things, I can see that in this quote unquote analogy in a improperly built bridge. Now they both have a origin or inception of the move, whether it be the right hand or the left hand side of the bridge. And the opposite would be terminus, where the move that you think would be likely completed, the target, or draw on liquidity. Now you might not understand inefficiency in price. I'm going to cover a lot about that very thing tonight, but it's still only scratching the surface. It's a very deep subject, and I promise you it goes much further than what would be understood as a commonly referred to as liquidity void. Okay, that's tossed around rather loosely without really understanding deeply what it is that entails. Now, sometimes when there's a gap in price, the market itself, the algorithm, will return back to those areas and revisit them. Now, that might be a fair value gap. It might be an actual gap where there's a session ending and a session opening. For instance, we're trading the index futures market. They close at 5 p.m. in the evening time in New York time, and then they reopen at 6 o'clock. So there's an hour lag where there's no trading. That creates opening gaps sometimes. So that's a real gap. Sometimes intraday, you may get a gap because of news or some unannounced geopolitical event, and that creates a real void in liquidity. That means there is an absence of any trading. Okay, the word void, when it's associated with liquidity, implies that there's absolutely no trading there at all. When we have a fair value gap or a volume imbalance, there's a specific void of a specific type of liquidity. And I'll touch on that when we get further in the lesson. But when we have an actual gap, when there is no trading, that's usually seen with session opening and closing or weekly openings, where there's a gap between where it closed on Friday and where it opens on Sunday. So that weekend gap, or we commonly refer to as the Sunday gap opening, many times that is formed because there's a imbalance created at that opening. That imbalance or inefficiency creates an actual gap where there is a real liquidity void. There's an absence of both buy side and sell side. No trading took place at all. So the market likes to draw back into those areas and use them as a means of recapitalizing and finding fair value, and then it can continue on in the direction it gapped, or it can trade beyond the gap and come back and treat it as a support or resistance. So we have efficiencies in price when the market returns back to these inefficient price points, that being the gap, the fair value gap, or the volume imbalance. So when I'm looking at price, the first thing I'm looking for is where is it likely to go? What's the draw on liquidity? Because if I can understand that, then I know I have framework for a trade idea. I can build a bridge from where market price is right now to that draw on liquidity. Now, here's the wonderful thing, and this is what many of the new students that come to my fold find themselves stuck in. They think that the draw on liquidity must be traded to, or it's a failure. So it's a all in and collect everything at the target, or failure. Because they've listened to other people claiming to be a mentor, claiming to be a profitable trader, claiming to be 20 years in the business or whatever it is that they say. And they give terrible advice about how you cannot do well by opening yourself up to a measure of risk. And then as the trade moves in your favor, take partials along the way, because the assumption is that your trade is a losing trade. So therefore, you're going to get the maximum loss. I have lessons on how we can mitigate some of that. Not all the time. I mean, there's times where I get a full stop out, and it happens, folks. It's going to happen to you too. But the things I teach in terms of characteristics and price action, those things will many times tip you off before the market really does the majority of the damage that would be available to the stop loss being hit. In other words, if you open up a trade, whatever that maximum stop loss is at the time of entry, we don't keep it there. And it's not going to stay the same measure of risk through the life of the trade, especially if it starts moving in a direction where it allows us to take partials. Because every time you take partials, you're building your bottom line and you're reducing the open risk in that specific trade. So when new traders come to me, many times their mindset is fixated on how much they can make, when I want you to focus on how much risk is there, how to control that risk, manage the risk, and if you can do that well, money can deposit into your account as a default. Now, it doesn't mean it happens by magic. You have to understand how to manage a trade. You have to be able to pick the right direction. You have to be able to time the trade. All those factors come in, and I teach all that on this channel for free. But new students come to me and they come in with really bad habits or expectations and grossly unrealistic expectations. They want to be able to take a $100 account and turn it into 5,000 in a month. I'm not promising you're going to be able to do that in the first month learning here. So I don't think that's not likely to happen here. Now, can you do something like that with years of experience based on the things I'm teaching? I believe yes, but it's going to take a lot of work. I don't want to give those types of expectations out, but I want to remind you and ground you right away, especially if you're new. These types of ideas, like I mentioned in the title, that this is a bridge builder. This helps you understand what it is that you're trying to do with the information I teach on this channel. So when we see price return back into these gaps, into these volume imbalances and or fair value gap, that creates efficiency in the delivery of price. Then the market is more free to move in the direction it was going in prior to returning to the inefficiency. So the market's always going to seek fair value, efficiency, and yield. Think about what I just said now. It's always going to seek efficiency. That means it's going to go back and redeliver. What does that mean? Price will go back up to an area where there is an inefficiency. That is a redelivery. That is not price being rebalanced. That's a misnomer. And this is not a knock against Mr. Chris Lori, but I've never liked his definition of that being rebalanced. That's not rebalance, that's redelivery. And I'll show you exactly what rebalancing in price is. When there is a gap in the form of a fair value gap or volume imbalance, when price goes back up into that or down into that in deference to when it's bullish, it returns back to that area and reprices to it. And it allows inefficiency in market price delivery. Now, once that happens, that may or may not be a trade. It may be a reason for you to trust that the trade that you're in should move in your direction now. I many times use it as a way of pyramiding. So in other words, I went in with, say, 8 contracts on the S&P. I'll go in and add 4 more at a period of where the market goes back to an old inefficiency, and then when it does that and reprices to it, now it becomes efficient. Then the market is allowed to be delivered in the direction, hopefully, in my trade. So if I see that as an opportunity, I can pyramid and build my position larger. And every time it does these types of things, I can build a larger position and therefore make more money in the trade. Now, if I'm wrong, it just means that I'm assuming more risk and I have to manage it a little bit differently. But larger positions obviously bring with it larger risk. And that obviously requires more experience. And if you're new, you don't have that yet. And just because you watch my videos, it does not mean that you can do it too. You have to do a lot of studying, a lot of practicing, and it's a skill set that is derived from doing a lot of things that are going to feel counterproductive. But it's like anything else that's worth doing. If you want to be a doctor, you want to be a fighter jet pilot, you want to be an airplane pilot, you know, these things require a great deal of study and practice and case studies and just honing that craft. And this is extremely technical, and you have the problem of your personality and your impatience standing in your way. But when you have these specific things in price, looking at it over time, you'll be able to push those bad habits, those character flaws that is existing in every one of us. I have character flaws. I'm bipolar. And all these things, and I'm a perfectionist on top of it. So I have a lot of things that go against me that I have to wrestle with. You're going to have your own things too. And you don't many times know what they are until you start trading and until you observe and journal what it is that you're feeling emotionally, psychologically. What were you stressing about? What did you feel overconfident about? when you went into the trade? What did you see? And the reactions after the trade either comes to fruition in a profit or stop out. You have to record all those things, and you have to do it for as long as you're a trader. I still do those things, and I'm about to be in the business 30 years, and I still do this. It keeps you dialed in. It keeps you focusing on the right things and not deviating from the things that you've grown to understand and trust as a technical trader. All right, so with all the boring preamble out of the way, I know some of you will just scroll through the video until you see a chart, and then that's where you'll stop. But you won't learn what it is that you should be learning here if you do all that stuff. And that's why I also delete people that make a comment, and I don't really let comments anymore because you can see it's been a sugar fest since I've been doing it. But I don't like when people say the video begins at this minute mark. You're cheating people from understanding what the premise of the video is. There's a monologue there, yes, but it's to get your expectations in alignment for what it is I'm trying to teach. Here we have the December contract, the S&P for 2022. And I want you to take a look at price, and I want you to find what you think is the dealing range for this particular time frame. Now, don't be upset if you get it wrong. Okay, you see that high right there? Why am I picking that high? We had a low that was broken. We came back up into balance. This low to this high, that is a fair value gap. This is a volume imbalance. There's two of them here. Price trades up into that, and then it's allowed to go lower. I'm using this candle here because it's the high between this candle's high and this candle's high. So it's a swing high. 3 candles. You don't need 5. If you're waiting for 5 candles, you're going to miss the move. Okay, so we don't use Williams fractals. Swing highs and swing lows are simply just 3 candles. Okay, 1 candle in the middle, lower high to the left, lower high to the right. That's a swing high. A candle in the middle with a higher low to the left and a higher low to the right is a swing low. Very simple. Now, the dealing range low is down here. Now why? Because we had the market trade multiple times lower, and we went into a higher time frame area where we mentioned that it was likely to have a bounce. And I'm going to refer you back into Twitter, and around this time you'll know that we were expecting some bit of a bounce. Eventually, the market on this particular day had a up close, and we were likely to see this high taken out. Draw on liquidity is the here, and should it trade higher to at least equilibrium to this high and that low, and the way you find that is to simply put a Fibonacci retracement from here to here and post it with the 50% level. So we want to see price try to gravitate back to 50%, which is equilibrium, and or preferably higher. That would take us into this volume imbalance right in here. Okay, so the volume imbalance is where there's a body in one candle and a wick that closes or bridges the gap that would otherwise be there if this wick didn't exist and this wick didn't exist, and they just had this candle's body and this candle's body, there'd be a gap there. Well, because there's a wick here and here, this is a volume imbalance. That's inefficiency. So the market will go back algorithmically back to this area. So we note that here, and that is a premium array. From high to low, half that move was about right here, and it's above 50%. So this is definitely a premium level. So it's going to be a draw on liquidity. So the next day, you would be expecting price to likely trade at least to this high and through it. And if it continues the very next day or the next day or along the course of the week, you would try to see if it's going to trade up into this area here, and then maybe reach into this fair value gap there between this candle's low and this candle's high. So what this is noting is internal range liquidity. What does that mean? From this high to that low, I don't need this to trade above this high to find a trade. So if it's going to draw back up into this area here, this is internal range liquidity. It's going to run up into this area, and it's going to act as the terminus from the move from here that I don't necessarily have to be a part of, but at this candle's close, before 6 o'clock on the next trading day when it opens up again, I know that I'm likely to do what? Draw at least to this level here, that's near term, and then here. It's going to reprice back to that level. Why? Because we've already seen multiple times go lower, and this candle has really shown a willingness to want to reverse. We don't know that yet. We want to see how it opens the next day. So from this low to here, this is how we're building a bridge. From this low to here, that is a bridge. Thinking of it like an analogy. This is where the market is, and where it opens, it's going to move to this level here. Now, it may take more than one candle or more than one day, but that's the logic. So here is the inception of the move, and terminus would be here while it's bullish. But when it gets to this level, then I'm going to look for evidence that it's likely to do what? Reverse. Why? Because the market's bearish. There's nothing bullish about stocks right now. Okay, so all this is going to be is a small little bounce, which is kind of like what I was building up as we were dropping down. It's likely to build a bounce in the marketplace. And that doesn't mean creating a low or a bottom. It just means it's going to reverse short term, run some stops, return to fair value. Not that this is a fair value gap, but this is fair value if it goes back up into here. And it's inside the range from this high to that low. I do not need to see this high taken out to find a trade or frame a trade. And when it gets here, I'm already expecting the likelihood of maybe trading up to here, but then I want to see the long-term trend resume, because seasonally speaking, the tendency is for the market still to continue lower. And nothing right now is bullish in stocks. It's horrendous right now. So the likelihood of lower prices is favorable, but I have to submit myself to the likelihood that the market can go up to this area here that's in orange, because this imbalance here in the form of a volume imbalance. There was trading. You can see it with the wick here and the wick here. But the bodies of the candles, I like to see them overlapping. Like this body here and here, it overlapped a little bit. Small little volume imbalance in here between the separation of that candle's close and that candle's opening. See that? That's a volume imbalance. And this is pretty much flush. I wouldn't look at that as a volume imbalance. But you see how this overlaps a little bit like that? And that meets it also here. So there's an understanding in how price is delivered when you look at price like this, not look at Steve Nielsen's textbook of supposed candlestick patterns. I have no faith in that, and I'm not trying to be disrespectful, but the market doesn't work like that, folks. Okay, it doesn't do that. It's doing what I'm showing you here. It's going to these areas of inefficiency and fair value, and it's seeking liquidity, period. Okay, so if we know that this is likely to occur, we submit ourselves to that idea. So what does that mean the next day's bias would be? Bullish. Once it gets to this level, I'm thinking longer term that it should trade below this low, make a lower low. And this would be external range liquidity. But that's outside the scope here. I want you to understand that we can work inside dealing ranges and never see those ranges broken and still find profitability. So what am I saying here? Once it gets to this area here, I can build another bridge, theoretically in my mind, that once price gets to this level here, market price would be in this range, right? Assuming that once it gets there, then I could frame the logic that we could see it trade lower. We could trade down to this bullish order block, and that would be a trade in itself. So from here, this would be what? The inception of the move to terminus. And it doesn't need to take out that low. This is very powerful, folks, if you really put some thought behind it, because 90% of retail traders are doing some kind of breakout strategy. This is not breakout. This is working inside of a dealing range, navigating an old range of data, not needing it to go out to new highs or lower lows. It's just working inside of an old range. Old range being this low and then high. So you can see once we got up here the very next day, it was bullish. It opened, traded down, returned back to that candle's body or close, created what? A volume imbalance. We'll leave that outside the discussion for now because I've already mentioned it in Twitter this morning, or I can't remember when I did it. It was either yesterday or this morning, I can't recall. But the market rallied, went into the volume imbalance. Look at the bodies of the candles. See how it's respecting this area here? This is redelivery. Okay. Then the market trades down, works into these last two down closed candles. That is a bullish order block. It does that. And then I wanted to see at that time, I wanted to see if it was willing to go above this high here to get into this fair value gap. It was unable to do so. That's fine. I was long. I took some profits. It was done in a live account. It's shared on Twitter. You can go look over there. Then the market did what? It repriced lower, away from the volume imbalance. Once it does this, it's pretty obvious what it wants to do. It's going to do what? It's going to draw back into this low to high. So this low to high, this is another new dealing range. I don't need it to trade below this low, but on this candle here, before this candle starts trading, it opens, returns back into this candle's close, the volume imbalance. We are looking for price to go lower. The longer term trend or bias is bearish. So while I do submit that I believe that this low will be taken out, we don't need it to do that just for the sake of bias or building a bridge in price action theoretically. So from here, the inception of the move would be here to here, the order block. Okay, and you may not know what an order block is, and that's fine. But this is a foundational study. So it kind of like gives you a framework to go in and expect these types of trades, these types of frameworks, not buy, sell, like you see me do intraday like that. That's 30 years experience. I'm not saying that you're going to have that watching just YouTube videos. Okay. But these types of setups, I am confident that you can learn to do these, and they repeat a lot. And notice that we haven't even gone into the lower time frame intradays. We're not on a 1 minute chart where you see me thriving. You're not on a 5 minute, 15-minute chart, not even on an hourly, not even a 4 hour chart. We're still just on a daily chart. You can trade on this alone. You don't need to be in front of the charts or having to worry about your smartphone, keeping up with the marketplace, running your business, going to school, or working your job. You don't need to trade that way. And a lot of people come to me thinking, oh, I only learned how to do scalping at ICT and I can't do scalping, so therefore his stuff doesn't work. That's not true. I teach literally every facet of trading, every way, every way. I just prefer intraday because I can take a small amount of money and parlay that up really fast because I can find lots of setups that allows me to use compound interest and pyramiding. Whereas if I'm trading on a daily chart, the setups are far and few between. It doesn't mean that they're not good for you if this is what you have to do to find setups because of your life. Your circumstances don't permit you to trade with intraday. So don't view that as a weakness. There's always something to do, even on a daily chart. A weekly chart, if you're really just long term and it takes a whole lot of things for you to change your mind, you can trade off a weekly chart. I personally would drive myself crazy even trying to do that, but I have models that teach you to do that. It's simple. You apply everything you're trying to do in the lower time frame on that weekly chart. It's the same premise. Everything's there in that weekly chart the same way it's going to be in an intraday chart. It's just moving faster on a relative basis because you're looking at smaller time frames and putting large positions on. Whereas on a higher time frame chart, you're doing very, very small positions trying to capture big moves. So it's all relative. It's scalable. But you can't try to do more than you're comfortable doing because you will fail no matter what it is you're trying to use in trading. It may not be me that's the best mentor for you. Okay? You may not appreciate the things I'm teaching. You may find something else out there that's more appropriate for your particular personality. And even that could still be a failure in your hands if you're not lining yourself up with what is realistic. So hourly chart, here we go. Here's that volume imbalance on the daily chart. And we have a buy side liquidity pool. What is buy side liquidity? It is buy stops, basically pending orders that you don't necessarily have to see. Okay, I see all these guys out there saying, you know, you got to use the